Welcome back to Iraqi Dinar Intelligence, everyone, and get ready, because the developments currently unfolding within Iraq's financial structure are undeniably sending shockwaves across the entire global forex market. The consequential headlines you are about to hear are not merely speculation. Rather, they definitively mark a defining, tangible moment in Iraq's long journey toward achieving full currency reform. We are specifically discussing a strategic move so decisively bold that prominent analysts worldwide are accurately describing it as the most significant shift in Middle Eastern monetary policy witnessed in more than a full decade. If you have been closely monitoring Iraq's Dinar narrative, today's extensive update completely alters all prior expectations and understandings. From the establishment of sophisticated new exchange mechanisms to the adoption of fully IMF-approved financial frameworks, the complex pieces of a long-awaited national transformation are finally and visibly locking into their precise positions. Therefore, please settle in, remember to engage with the content, and remain with us until the very end, because the comprehensive information we are about to reveal could totally rewrite your entire perspective on Iraq's economy, the dynamics of global oil trade, and the potential future of currency alignment in the pivotal year, 2025. The global financial community awoke this past week to credible news that Iraq has quietly, but successfully activated a brand new currency contract framework, which effectively introduces a sophisticated dual-rate model that strictly separates the public market exchange rate from a significantly higher internal institutional contract rate. That specific technical sentence may sound unduly complex, but its underlying implications are truly monumental. It specifically means that Iraq is now internally stress-testing an exchange valuation that is intentionally not yet publicly visible on any open forex screens, but which is already being actively utilized in various selected international trade agreements. For the typical casual observer, this may superficially appear to be nothing more than a minor local policy adjustment. However, for those carefully watching the finer details, it represents the critical launchpad for something far more strategically profound. The official revaluation phase that Iraq has been diligently preparing for since decisively stabilizing its national reserves and comprehensively reforming its core banking network. Leading economists are now aptly referring to this calculated move as a controlled ignition. This is the precise type of controlled internal trial that conventionally occurs immediately before any nation's currency is fully launched onto the global trading stage. So what exact practical benefits does establishing a contract rate actually provide for Iraq's overall economy? Imagine a scenario where Iraq sells a substantial amount of oil to a key trading partner, and instead of entirely settling the transaction in US dollars, a crucial portion of that transaction is strategically executed in dinar, but critically, not at the normal, currently devalued public rate. Instead, that dinar portion is formally exchanged using a pre-agreed-upon, significantly stronger internal value. That specific value is the contract rate, which is a powerful internal benchmark Iraq can effectively utilize to both evaluate and progressively standardize future international trade executed using its own currency. This process is not merely a test run for procedural convenience. It is a deliberate, calculated step toward achieving full currency sovereignty, a focused effort to transform the dinar into a globally respected and fully accepted settlement option, rather than simply remaining a domestic note that is perpetually tethered to the dollar's value. What makes this recent development even more utterly fascinating is the fact that numerous high-profile reconstruction and infrastructure projects within Iraq are now reportedly being settled precisely under this new model, clearly signaling rock-solid confidence from the highest financial authorities that the new internal value system can be successfully sustained under real-world pressure. Leading financial analysts are now universally characterizing this development as a profound turning point in Iraq's entire modern history. For a number of years, Iraq's monetary authority has necessarily operated under intense international supervision, only managing to achieve gradual, difficult progress in rebuilding financial credibility after long periods of instability and conflict. But this specific time feels unequivocally different from past efforts. The evident scale, the precise timing, and the clear strategic precision of these recent, major adjustments align almost perfectly with the comprehensive IMF reform benchmarks specifically designed to systematically modernize archaic exchange frameworks and successfully integrate emerging economies into secure digital banking networks. If Iraq is currently meeting these rigorous international standards, it fundamentally means that the IMF now perceives genuine readiness, a necessary level of institutional stability and operational transparency that fully permits wider rate flexibility and monetary autonomy. This is certainly not just about printing fewer physical notes or simply rebalancing existing reserves. It is intrinsically about demonstrably proving to the global community that Iraq possesses the requisite capacity and commitment to manage its own monetary destiny responsibly and effectively. Now let's thoroughly examine the subsequent domino effect, because this situation is no longer confined solely to Iraq. Within a very few days of the contract rate announcement, discrete but notable activity began rippling through several major Tier 1 banks worldwide. Leading financial institutions in both the United States and various European nations started actively updating their highly complex internal systems to incorporate new, specialized verification fields specifically for contract-based foreign exchange transactions. While this may sound like nothing more than routine technical maintenance, banking insiders are confirming that the precise timing is entirely non-random, noting that major banks almost never proactively modify their sensitive FX infrastructure unless they are expecting imminent regulatory changes or substantial market shifts. In simpler terms, the global financial systems are currently preparing to fully synchronize with Iraq's upcoming currency transition, and when these massive institutions begin their preparations, they are preparing for definitive action, not just fleeting rumors. They are actively constructing the necessary digital rails that will be required to seamlessly carry this reformed, revalued currency into widespread mainstream circulation precisely when the conditions are optimally ready. Observers have also astutely noted how perfectly this latest reform effort ties into Iraq's previous digital Dinar initiative, which is the massive modernization effort of its banking supply chain that first commenced last year. Now every single physical Dinar note, every electronic transfer, and every single cross-border payment transaction is fully traceable under the new centralized digital compliance system. That degree of comprehensive oversight was entirely impossible a mere decade ago. Today, it stands as a fundamental cornerstone of Iraq's rapidly emerging legitimacy in the realm of international finance. By meticulously introducing this blockchain-style tracking mechanism for its entire monetary supply, Iraq is effectively eliminating the pervasive black market risks that historically distorted its official exchange rate. And that particular structural guarantee is precisely the reason why astute global investors are now paying such intense attention. A demonstrably transparent, fully traceable currency system, solidly backed by rapidly rising oil output and increasingly stable governance, unequivocally equals enhanced confidence. And that confidence is the very first, essential ingredient required for any successful currency revaluation. Let's now pivot to the subject of oil, because energy exports fundamentally remain Iraq's undisputed financial heartbeat. Under this carefully designed new exchange structure, Iraq has begun the process of settling a highly selective number of energy agreements directly in dinar, rather than relying exclusively on the US dollar for settlement. This subtle but profound change carries enormous far-reaching implications. It specifically means that the intrinsic value of the dinar is now formally linked not solely to domestic monetary policy, but directly to the massive global energy trade. Every single international contract that is successfully settled in dinar powerfully reinforces its growing credibility as a legitimately tradable currency. Think of this process as essentially compounding trust over time. Every single time Iraq successfully honors an international contract using its own currency at a demonstrably strong internal rate, it progressively adds yet another vital layer of global financial validation. That precise, steady mechanism is exactly how a relatively regional currency gradually transforms itself into a serious contender on the vast world financial stage. This happens one oil shipment, one crucial infrastructure deal, and one successfully verified exchange transaction at a time. The earlier, gradual introduction of smaller physical denominations, such as the 5,000 dinar note, initially seemed relatively trivial, but it now fits perfectly and strategically into this much larger integrated plan. If Iraq's currency value were to rise significantly, the larger existing denominations like the 25,000 dinar note would instantly become functionally too valuable for routine, everyday commerce. Smaller physical notes make daily commercial activity practical and manageable during the highly complex transition phase. This methodical, gradual approach, releasing necessary new denominations before initiating a major rate shift, is a definitive hallmark of professionally organized and managed revaluation events. It deliberately allows domestic markets to adapt smoothly and successfully, minimizes the potential for economic chaos when the significantly new higher rates eventually and officially appear. This structural preparation also powerfully signals to keen international observers that Iraq is meticulously preparing for a functional, genuinely sustainable rate increase, not simply a sudden, uncontrollable speculative jump in value. This is strategic financial engineering in action, not a mere series of coincidences. From a comprehensive global market perspective, the exact timing of this move could not be more strategically interesting or significant. The year 2025 has already seen notable turbulence in the forex arena, characterized by major oil price adjustments, shifting interest rate policies across continents, and renewed, intense discussions about global de-dollarization efforts. Iraq's latest calculated move slots perfectly and neatly into that very narrative. As numerous nations worldwide actively diversify their necessary reserve holdings and explore expanded bilateral trade conducted in local currencies, Iraq is strategically positioning itself to become a key center of this transformation. The nation is not in any way rebelling against existing global financial systems. It is intelligently evolving and adapting within them. By diligently aligning itself with strict IMF protocols while simultaneously asserting clear national monetary independence, Iraq is powerfully signaling that it is fully prepared to play by international rules without ever sacrificing its essential economic sovereignty. This incredibly delicate and intricate balance is precisely what modern monetary policy experts refer to as strategic autonomy, and it is rapidly emerging as Iraq's definitive new economic identity. Let's now take a very close, detailed look at how international investors are actually responding to these latest developments. Over the course of the past few days, leading online trading platforms and global investment forums have registered a very noticeable spike in widespread discussions regarding emerging market currencies, with a particularly intense focus on the dinar. While the vast majority of retail investors cannot currently access the new internal contract rates, institutional investment players are already actively calculating their potential exposure and optimal entry strategies. Sophisticated hedge funds that specialize specifically in frontier markets are now actively exploring various ways to meaningfully participate in Iraq's upcoming infrastructure bonds, which are highly likely to be priced using the new internal valuation model. The general market sentiment is rapidly shifting away from cautious optimism and is transitioning directly toward calculated, strategic positioning. When powerful, large-scale investment funds begin thoroughly analyzing a nation's currency reform in such meticulous detail, it serves as an extremely clear and undeniable sign that the underlying story has decisively moved from mere rumor to imminent reality. Within Iraq itself, the public and business response has been equally electric. Business owners, especially those heavily involved in the import and export sectors, are clearly beginning to sense the strong gathering momentum. The government's official Economic Communications Office has heavily emphasized the need for stability, consistently reminding the citizenry that the entire reform process is meticulously staged and is being carefully managed at every step. This public reassurance is fundamentally key because underlying public confidence underpins all currency success. A national currency simply cannot be successfully revalued unless the people who use it every single day genuinely believe in its long-term strength and stability. Unconfirmed reports strongly suggest that local banks have already received and successfully installed updated software specifically designed to internally accommodate new rate structures, thereby ensuring that when the public phase officially begins, there will be no significant system disruptions or failures. This exceptional level of technical preparation demonstrably showcases a degree of strategic foresight that Iraq has simply not exhibited in decades. The underlying involvement of the IMF, though not publicly detailed, is clearly evident through the seamless synchronization of Iraq's recent policy steps with long-established global monetary standards. These recent specific milestones perfectly match the exact framework successfully employed in other major currency transitions worldwide. For example, before any country is permitted to achieve full open market revaluation, it must first unequivocally prove its fiscal discipline, operational transparency, and stringent anti-corruption control. Iraq has diligently spent multiple years strengthening all three of these crucial metrics. Official foreign reserves now exceed an impressive $100 billion. Domestic inflation is well contained and manageable, and the dinar's new digital traceability has achieved rigorous compliance benchmarks that now genuinely rival those found in certain developed markets. When all of these vital financial metrics successfully align in this way, the IMF typically moves to support and endorse broader international market recognition. That foundational readiness is precisely why experienced analysts believe Iraq has just definitively crossed the final preparatory threshold before an anticipated international currency adjustment. Global forex strategists are already beginning to describe this unfolding event as a genuine shockwave event, not necessarily due to immediate market volatility, but because it is successfully introducing a credible, new player with fundamentally sound economic credentials into a competitive landscape that has long been overwhelmingly dominated by a very small handful of established reserve currencies. When a resource-rich nation like Iraq successfully modernizes its entire monetary system, it fundamentally challenges old, static dynamics. Global oil buyers now have a legitimate alternative settlement currency option. Regional trade partners gain a much-needed diversified trading option, and the overall global market becomes marginally less dependent on the single primary reserve currency. The ultimate ripple effect of this action may unfold slowly, but its impact is undeniably real and lasting. And as modern digital exchanges continue to rapidly expand, the speed at which such carefully managed transitions influence global capital flows is only increasing dramatically. Let's now shift our focus to the practical implications of all this for ordinary dinar holders located across the world. Firstly, the consistent advice remains that patience is absolutely key. While the core infrastructure is currently being rigorously tested and officially verified, the public exchange rate has not yet officially changed or moved. Attempting any early conversions or falling victim to speculative, unverified exchange offers remains incredibly risky. The single safest and most prudent approach is to simply hold your currency, remain exceptionally well-informed, and patiently wait for the final, official confirmation from recognized, legitimate financial channels. When the final official revaluation does ultimately occur, it will be highly public, fully documented, and officially validated through all legitimate, established banks. This specific stage is emphatically not the time for attempting financial shortcuts. It is the crucial final preparation stage, the quiet period just before the official global announcement. Those who remain patient and continually informed will ultimately benefit the most when the official doors are finally opened for transactions. Now let's consider the massive macroeconomic implications of a successful revaluation. A successful revaluation and subsequent currency modernization would instantly and dramatically boost Iraq's global purchasing power, significantly strengthen domestic wages, and aggressively attract substantial foreign direct investment. Businesses already operating within Iraq would find it significantly easier to conduct trade, manage payroll, and import necessary goods without suffering massive currency conversion losses. It would also structurally reshape Iraq's sovereign balance sheet with its various international lenders, potentially significantly lowering its borrowing costs and dramatically improving its overall credit ratings.